All right, I guess we can go ahead and get started. Thank you, everyone. Welcome to the Sage Investor webinar. My name is Jen, and I am a co-founder of the Sage Investing Group, along with Maggie and Lana. Thank you so much for joining us today. If you have any questions, please go ahead and type them into the chat box anytime during the presentation, and we will get to them at the end. So today's webinar is focused on helping you guys understand the leverage that you have when you invest passively in multifamily syndications. As busy professionals, I know that we often try to seek for ways to make our lives a little bit easier, a little bit less hectic, and to be able to enjoy more of our lives in the present. So I know that we seek for all sorts of leverage in our lives, but when it comes to investing in real estate, most people aren't really aware that there is actually a huge amount of leverage that you can tap into if you're finding it difficult to do the real estate investing on your own. So today's presentation, we are going to focus on 6 different leverage points in multifamily investing, and we'll also discuss how these levers actually strengthen the 4 principles of conservative investing that we like to invest by. Now, before we dive into this riveting topic today, let me just introduce ourselves really quick. The 3 founders of the Sage Investing Group, we all have a Big 4 accounting background, which means that our background is rooted in audit and risk management. So our jobs, essentially, prior to becoming full-time syndicators, involve checking facts and figures to make sure that they are reasonable, and we helped mitigate risks for large financial institutions on Wall Street to ensure that they are making sound investment decisions for their investors. So after spending a little bit more than a decade each in this profession, we decided that our true passion really lies in real estate. So today we use our combined 35 years of professional experience in audit, finance, accounting, along with our real estate investing experience and the thousands of hours that we've spent thus far underwriting multifamily deals to do what we do now in multifamily syndications. And that is we critically use our auditing power to vet these deals so that busy professionals like you guys can invest with greater confidence in these syndications. And so today, we have over 190 members in our community who are verified investors, and we also have over 460 Facebook followers. Collectively, we have participated in 14 deals, totaling over 3,000 multifamily units, and with a portfolio size that values more than $350 million. And we're really excited to be adding another 360 unit investment to our portfolio soon. So evidently, you can probably guess that we believe that multifamily is one of the best asset classes out there for us. And we've created this webinar to help you guys provide educational content so that you guys can decide for yourself if this is also the right investment strategy in your life. So this webinar is really for anyone, who has tried investing in syndications before, but you ended up backing out because you might feel like you didn't know enough or confident enough in the deal, or maybe you invested in syndications before, but yeah, you feel like you did not know enough. I guess I read that one already. And then, or you feel overwhelmed by all the information that's out there, so you end up not investing. So just a little disclaimer that we learned from our auditing days that, it's critical to CYA, which essentially means to cover your ass. So we naturally have to make a disclaimer before we start our presentation that, this webinar is for your education only. And although all of us have a CPA background, we're not a legal, we're not a financial or tax advisory firm. So please do consult with those respective professionals for legal, financial, or tax-related questions. And please know that we cannot guarantee any returns to any of our investments because there are always risks associated with any investment. So with that, we hope that after today's webinar, you guys will walk away understanding what are the 6 ways investing passively can help you create leverage, and why leverage is essential to growing your wealth. And thirdly, how can you create this leverage to accelerate your investing success? So before we get started, let's define what exactly leverage is. Like, why is it important and how it impacts you? So as you all probably know, a lever is a tool that you can use, such as a fulcrum, for example, where with a little bit of effort on one side of it, you can tip the scale to produce massive results on the other end. So in the case of a syndication, leverage essentially allows you to spend a little bit of time learning about an investment in the very beginning of the opportunity, so that once you decide that you want to put your money to work in that investment, you can exert a little bit of effort. So once you decide to invest in that investment, you can exert a little to no extra effort thereafter to generate typically above average returns for yourself. So I think it's pretty similar to maybe like stock investing, but with real estate investors, typically you do receive far greater benefits, right? Such as you get tax benefits, you get cash flow, you get a little bit more stability versus the stock market, which can be quite volatile, as well as you get more controlled appreciation. So these are a lot more greater benefits in real estate investing compared to investment in other assets. So then why is it that having leverage is important, and how does it impact you? So I think as we go through the 6 levers, we will be able to answer those questions for you. So let's dive in. One of my favorite levers of all is time. Time is pretty much is our most important resource, right? You cannot buy more of this. And as busy professionals, most of your time is probably spent producing your active income. And after working on the weekends, you probably want to spend some of that time, spending time with your family. You want to spend some time relaxing and do things that you really enjoy. So with our plates pretty full, I think the lack of time is the reason why so many people never get started investing in real estate. And for those who do get started, time is also the reason why so many investors, they get stuck and they never scale their real estate portfolio, right, to the point where it can create true wealth and time freedom for themselves and the family. So the latter scenario where, the limited time to scale your portfolio was my situation. So I know that one all too well. When we started scaling our portfolio a few years ago with single family and small multifamily properties, it quickly became apparent that it was going to be a tremendous amount of work and time in order to reach that financial freedom number that we were trying to aim for. So I know television with the flipping and everything like that makes real estate investing look really glamorous, but it gets real when you have to deal with tenants, for example, who skip out on rent, and tenants who leave a huge mess for you to clean up after they've moved out. So like, for example, in one instance, one of our tenant moved out of one of our rentals. And in an effort to clean up the property after they moved out and left so much junk for us, we decided to hire a junk removal company. So, while they were taking away everything that was left behind, they happened to also take one of our humidifiers that was in the basement. It was there for a reason. And so we didn't really know that this happened until mold started growing in the basement. And so it cost us thousands of dollars to remediate the situation. So, points like this and several other points throughout this investing journey, I came to realize that I was really spending so much time outside of my W-2 job, to generate like $200 to $300 and like cash flow each month after all expenses were accounted for. So I felt like I really didn't have leverage at all, and my time that was put into the investment really wasn't worth the return that I was getting. So then for us, the question then becomes, how can we do better? How do we invest in real estate without having to put in so much work and still get great returns? So believe it or not, time is actually the biggest leverage point when you invest in real estate syndications. You can leverage all the time that the general partners they put into identifying markets to invest in, the thousands of hours that they spent underwriting to find that one deal that works. And I know Lana and Maggie can tell you all about that because they're underwriting all the time. And you can leverage off of the time that the general partners put into creating a sound investment strategy that would generate 10% plus cash on cash return for investors. Not to mention the time and money that is put forth into the deal to conduct due diligence to make sure that it is a sound investment for all, and so much more. So as a limited partner, you leverage the GP's time, right, to do all that legwork. You only need to spend the time necessary upfront to do your due diligence on an investment opportunity. And then in exchange for that small amount of time relative to what the GP is putting in, you get to reap in the benefit of the returns that the investment is projected to get, thanks to somebody else's hard work and time. So that's a huge one for me. I love the time saving that passive investing has provided to me. And knowledge. So a big hurdle that keeps most investors, I think, from scaling from the single family side to the multifamily side is the perceived lack of knowledge and expertise on that multifamily investment strategy, and also the many markets that are out there. Among other things. So, it's one thing to buy a single family property that's within driving distance from your house, right? And it's a completely different story to buy a 75 unit apartment complex that is a few states away. Without that necessary knowledge to know how to run and to protect that investment in the first place. So in real estate syndications, you get to leverage off of the general partner's knowledge of that market that they're investing in, their investment strategy, their construction know-hows, and the systems that they have put in place for effective asset management. So the next one, the next lever that is expertise. As you all know, becoming an expert takes time. It takes effort and experience. So no matter what field that you're in, becoming an expert in passive real estate investing can be daunting and it can be very time consuming. So when you invest alongside with others, you are tapping into their years of success, of failures, and all the knowledge that they had to accumulate, right, to get where they are, without you having to actually experience it and go through it yourself. And that ultimately helps you reach your financial goal much sooner. In a real estate syndication, you get to leverage the general partner's track record, and you also get to leverage off of the business systems that they have created for running a multifamily syndication business. Next is network. So when people are making the jump from single family to multifamily, you also need a different investment team, right? So for example, a residential realtor is not going to be the same broker, right? That's going to be equipped to help you find a 75 unit building. So the same thing applies for finding that property manager, the insurance agents, contractors, lenders, etc. Like commercial real estate has its own types of vendors that you need to work with. So building a good team from scratch takes a lot of time. So you can leverage a reputable operator who has these teams built out and ready to go. You bypass all the initial trial and error of going and building a team on your own. And in a real estate syndication, you get to leverage off of the general partner's network of brokers, their property managers, lenders, construction crews, even investor connections, and so forth. So network is critical. It takes a huge team of knowledgeable people professionals really to run a syndication business and making sure that it's successful. Next is credit and lending. So when you transition also from single family to multifamily properties, the track record, credit, lending, these are three huge obstacles that many investors will encounter. The lender is no longer really just looking at you and limiting your loan to what you can actually afford based on your income level. But even if you have a portfolio of, let's say, 30 single family properties, to jump to a 30-unit apartment building requires a track record of that type of asset, right? Before the lender will even consider you to obtain a loan. So in real estate syndication, you can leverage the general partner's track record, their credit, and their ability to secure a loan. And this is a huge lever, I think, for limited partners, because now you have outsourced that debt obligation that you would otherwise have to take on your own to the general partners, right? So there's no need for you to really apply for your own loan and be personally liable for it. And next is money. The sixth lever is money. I don't know a lot of individuals who have millions of dollars sitting in their bank account. So it makes it virtually impossible, really, to secure a down payment and to make the reserve that's required to acquire a large multifamily property. In a real estate syndication, you can leverage not only the general partner's money, but you also can leverage off of other investors' capital to make that down payment. And many people may not realize, but even before the deal reaches the investor's desk, right, there's actually hundreds of thousands of dollars that the general partners have to bring to the table first to pay for things such as like earnest money deposits, for legal fees, right, to pull together the purchase sale agreement, to put together the PPM, things like that. And also they have to pay for due diligence fees. They have to pay the contractor to come out to the site and to look at the property, walk each unit, and come up with a CapEx budget for that investment. So those are just a few of the things that they have to pay up front as a general partner. So that's what I meant when I said like leveraging off of the general partner's money, as well as the other investors' capital. So then by pulling together these resources together, we can buy a bigger, a better property than we would otherwise be able to do on our own. So these are pretty much the 6 points of leverage that you get when you invest passively in multifamily syndications. And the next question is then, how do these 6 levers really reinforce our 4 tenets of investing? Well, in our past webinars, we have talked about this 4 tenets of investing in a little bit more detail. But today we're kind of talking about it in terms of leverage. So these 4 tenets are essentially our primary objectives when we invest in multifamily syndications in order to help our investors reach their financial goals faster. These 4 tenets for investing includes investing for capital preservation. So just making sure that we don't lose any of our initial capital, especially for our investors. We invest for cash flow, for appreciation, and for tax benefits. So then how does the 6 levers that we just talked about help you grow your wealth and accelerate your investing process? We're going to go through each of these one by one and kind of talk through them to illustrate our point. So number 1, leverage and syndications really do help you protect and preserve your capital, which is the priority number 1. There are so many ways this plays out, but we will just talk about 3 of those ways for now, so as not to kind of overwhelm you guys. So first of all, the property is in the hands, right, of experienced operators who are looking out after your investment, because the general partners are equally invested, if not more, in that same deal that you are investing in. The general partners from the beginning, they have to put forth a lot of time, a lot of their effort, and a lot of their own money to make sure that the deal goes from beginning to the end smoothly, and to be able to take a deal and bring it to the investors in the first place. So, their interests are pretty much aligned with the investors right from the beginning. And as a limited partner, you are really leveraging greatly off of the professional property managers who are hired as part of the investment to manage the property. And these property managers, they're on site, right? They are vetting the tenants who are going to be living on the property. They are collecting rents. They are handling tenant issues so that you don't have to do any of that stuff. And because of the size of the property, there are actually even maintenance staffs on site that are responding to work orders from the tenants so that you don't have to call a plumber anytime that there is a leaky toilet. And then the third point is that the purpose of a multifamily syndication, right, it is to add value to the property. So not only are we preserving the capital, preserving the asset, but the general partners, we come in, we update the interiors, in the exteriors, we even make add amenities, right, to further increase that property's value. So that is the power of leverage, really, where you have a whole team standing behind an investment. Versus a portfolio of single family properties that you may have on your own. And you alone have to deal with all the pros and cons that come along with that. So the second tenet of investing is for cash flow. And remember, cash flow is king. In multifamily syndications, you get the advantage of the economy of scale by leveraging off of other people's time and money. So having economy of scales helps to ensure that your investment continues to cash flow, even if you have a few vacancies here and there. So compare that to a single family property, one vacancy in your single family property means a complete loss of income. But in multifamily, you can have, 10, 20, depending on the size of the property, 10, 20 vacancies, and your property would still be cash flowing just fine. Another factor that helps with cash flow is that you get to leverage off of the general partner's track record, credit, and ability, and credit and loan. I guess lender getting a loan in order to get that commercial loan, which means that a commercial loan generally has lower interest rates, right? It has better terms and lower interest rates. And having a lower interest rate typically helps tremendously with the bottom line for your investment. So less interest payment to the investors means more cash flow to the investors. And then another thing is that investors can leverage off of the sponsor's knowledge and expertise on how to implement an investment strategy so that would maximize the investment's return. So leveraging off of other people's money, whether it's the investors or whether it's the lenders, these funds are being used to purchase and then to renovate the property so that we can command market rents for our property, and thereby increasing our revenue and cash flow to the investors. If we're able to charge a little bit more for each unit because it's nicely renovated and it looks nice and new, then it's going to obviously help our bottom line and help create that cash flow to the investors. And then leverage, the third tenet is appreciation. Leveraging off of the sponsor's knowledge and expertise, once again, they know how to implement an investment strategy, right? And typically that investment strategy includes forcing appreciation into these properties by doing the value add that I just mentioned earlier. So for large multifamily properties, it acts more like a business, right? The valuation is really derived from how much income the property can generate. So this gives us a lot of control and opportunities to increase the net operating income through increasing the rental income, decreasing the operating expenses, or by even adding additional streams of revenue to our property. And all of this directly increases the value of the property. And of course, that gets passed off to the investors, upon refinance or upon the sale of the property, because the investors, the limited partners, get to participate in that in the capital gains. So then the fourth tenet, the last one, is in tax benefits. As you may all know, the biggest tax benefits of real estate investing is in the depreciation that we get. And when you invest in multifamily, you are leveraging off of the economy of scale, the size and the cost of the property, right? Which is usually multi-million dollars properties. And having such a large I guess like having a property of such value, it really warrants us to hire engineers who can conduct this cost segregation study. And a cost segregation study is it's just them coming in, the engineers coming in to a property. They can even do it via the computer, but they assign useful lives according to the IRS code, right? To all the various assets within the property. And the benefit is that anything that has a useful life of 20 years or less, we can actually depreciate in 5 years, within 5 years. So that means this is a massive amount of depreciation that is being allocated to the investors, who can then use the depreciation to offset things such as like distribution income, capital gains, and other passive income. So comparing this to single families, it's typically not worth it to conduct a cost segregation study on one single family property at a time. It typically costs like a couple of $1,000s to do so. So I guess the benefit is not really worth, what you have to pay for it. So what this means is that most, investors who invest in single families or smaller multifamilies, they will most likely take that 27.5 year straight line depreciation. So that means they take the cost basis of the property that they purchase, they divide it evenly over 27.5 years, and then each year they take the same amount of depreciation. So dividing something over 27.5 years means, smaller chunks, right, of depreciation that you can allocate to yourself. And so this means smaller tax benefits for the same amount of money that you invest in a single family versus a multifamily syndication. So I guess that's pretty much, that's pretty much it. And I just wanted to end our webinar today with a quote from Stephen Swede, who said, "Being rich is having money, and being wealthy is having time." And I think most people probably want both. You want money and you want time so that you can enjoy the money that you have. However, I think a lot of people think that they have to put in that time. Like, we're so used to thinking that we have to put in, all that time necessary in order to generate an equal proportion of money in return. So the more time you put into your job, the more time you put into your business, the more revenue you can generate, or the bigger a paycheck, may be, because maybe you get a bonus or something. But I hope if nothing else, the one thing that you take away today from the webinar is that, you have to work smarter and not harder, right? You have to use leverage wherever you can, especially in your investments, to gain that advantage so that you can have that money and the time as well to enjoy the money that you are making. So that's it. That's pretty much our presentation today. If you guys have any questions, the Sage ladies, Lana and Maggie, are on the webinar as well, and we'd be happy to take any of your questions. You guys can go ahead and put your question in the chat box, or you can unmute yourself and speak directly to us. That's fine too. And while I wait for the questions to come in, I don't think we have anything yet. While I wait for the questions to come in, I want to invite anyone who isn't a part of the Sage Investor Circle yet to join us. You simply need to visit our website here at sageinvestinggroup.com/join now. And you got to fill out a questionnaire, and most importantly, set up a call with us so that we can see if what we have to offer is a good investment strategy for you. And joining the Investor Circle and getting on a call with us is really the only way that we are able to share our future investment opportunities with you guys, so that you can start exercising some of these levers that we talked about today. So that's that. If you guys have any questions, please let me know. If not, I guess we can sit and wait for a few minutes. If not, that's completely fine. Thank you guys for joining us. If you think of anything after the webinar is over, feel free to email. Feel free to reach out to any of us, and we can respond to your questions via email afterwards too. You can email us at info. I don't have it on here, but it's info@sageinvestinggroup.com. So thank you guys for attending today and for sitting through with me on this webinar presentation. Hope to see you guys again next time. Take care.